And welcome to ETF Edge. This is your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. I'm joined today by Reginald Browne, GTS, and Tom Lydon of ETFtrends.com, as well as Matt Hougan of Bitwise Investments. He's out in San Francisco. That is the bridge behind him there, folks. The race to zero is ramping up. Charles Schwab announcing last week that it's going to zero commissions on equities and ETFs after Interactive Brokers essentially did the same thing. I just spoke with Charles Schwab himself on our air moments ago about the need to be competitive in this environment. Reggie, this whole race to zero debate seems to me like it's less about getting those commission dollars and more about keeping clients and increasing assets. In short, it's about scale at this point. What's your thoughts?
Well, I think another spin is it's about increased investor confidence and another log on the fire around transparency. Look, the ETF industry has done a tremendous job around innovation. This is now nothing more than gale force winds behind the ETF industry to get more assets and to drive investor confidence and lower costs.
Just on a question on the business itself, it seems like this is a little bit of a real shot across the bow to the competitors. We saw them all move, Ameritrade, E-Trade, all move down on this. Do you think, Tom, this could lead to more industry consolidation? Could this start something?
Well, absolutely, and I was surprised when you asked him, Bob, that he said that may be the case. I mean, they've got a pretty big checkbook, and when you think about companies like Betterment or Wealthfront, some of those robo-advisors, they may be free for the taking. Also companies like Robinhood and Acorn that have done a good job for this next generation of investors that run their portfolios on their phone. Now Schwab is clearly in that game.
So where does this end, Reggie? I'm thinking, I mean, obviously commissions are now zero, so where are you going to go from there? Schwab's got an enormous banking business.
They do.
More than 50% of their revenues are actually in banking, and they've got a growing wealth management business. You know, what else do you do here? I mean, do you offer higher interest rates to your banking clients? I'm trying to think of other ways that you could even ramp up the competition even further.
No, I really think it's about client engagement. You know, Mr. Schwab had said that there are other businesses inside of Schwab where banking and advice, and I think that's true for all the participants. There are other types of businesses inside that can capture the revenues as being shifted. But look, it's about client engagement. It's about growing the client sphere internally. I think these companies have it. You know, to understand how to pivot hard.
And how much, several $1 trillion in assets under management, obviously that's what you want to do. You want to keep the clients in-house. Right. One of the things we've noticed about these funds is they tend to be, these fund families, they tend to be very sticky. Yeah. It takes a lot for someone to decide, I'm out of here with Charles Schwab and I'm moving into Vanguard or something like that, right? Yeah. So you don't want to give them any excuse, essentially, to pull up and leave.
Yeah, and half of their income is from the financial advisor community. When you look at that and the loyalty of financial advisors that they've been serving for many, many years, they all benefit from that. Obviously, their clients benefit from that as well. And I think other areas as far as better execution on ETF trades down the road, we'll see that. Don't you agree, Reggie?
Well, I think the client experience is at all-time high with market access here. You know, getting midpoint pricing for U.S. equities across the board, ETFs, but also NMS securities. The investor experience is as high as it's ever been, and because that investor experience is so high, has allowed for the zero commission fee to occur in the marketplace.
But this has implications even across the ETF space. We've marveled 2,000 ETFs, 160 fund families, maybe 200 fund families at this point. We have been waiting for consolidation in the ETF space. When is that going to happen?
Yeah, it's capitalism at its best, Bob. Now with the new ETF rule, it's going to be easier for more and more ETFs to come to market. But as Reggie and I were talking about earlier, not all of them have the great products to bring or the gusto to get distribution behind it. We're going to continue to see more and more ETFs close as time goes on. And we'll see some rock stars develop in the years to come as well.
So you continue to see assets under management increasing in a small group. You think right now the top 10 fund families control 95% of the business, right?
Yeah, and that will continue unless we see changes in the marketplace. Hey, we've had a 10-year bull market. If there's some alternative strategies out there that may play well in the next 5 years, look for assets to flow in those areas.
Okay, I just want to move on here. I've got a bunch of topics, including gold I want to discuss here. The Wall Street Journal is citing a study on Monday that shows brokers at 4 major Wall Street firms have just 29% of their clients' managed assets in passive index funds. That's a surprise. That's well below the 45% passive rate for independent investment advisors. I want to just get some thoughts from you guys here and what you're thinking. Tom, this doesn't come as a big surprise to me. Brokers are naturally want to show they can pick some active fund managers who outperform at this point.
Yeah. Well, this is right up your alley. We talk about the SPIVA report that S&P puts out all the time, the fact that more than 90% of active managers underperform over 10 years. Bob, when we're talking about fees, performance has to be in that same dialogue. And as we continue on, those advisors that tend to be in the wirehouse area that don't have enough allocated towards passive and have higher fees, and most importantly, if they're actually making 12B1 fees or they're making other commissions that aren't naturally disclosed in a more public way, there's a lot more room for consolidation.
Matt Hougan, it's no surprise to me that obviously these firms here are embracing active management a little bit more. Should Wall Street firms be embracing passive investment more seriously than they have been?
Oh, absolutely, and it's going to happen, Bob. These are just the late adopters. The RIAs are the early adopters. The wirehouses are the late adopters. You're going to see that number tick up from 29% to well over 50%, I think, in the next few years. A lot of people think, indexes are now larger than active management. The game is over. I actually still think it's just starting. I think you're going to see index assets continue to grow at both the RIAs and the wires, and the wires are going to have to catch up quickly or they're going to be left behind.
And what's the implications for that, Richie? I mean, lower cost products they're going to have to keep introducing at this point?
Well, I think you'll continue, fee compression across the board will still occur, particularly in active. But I think there's always a room for active management in asset allocation. I don't think it'll totally go away. And I think a lot of those assets will be ported over into semi-active transparent ETFs that will be introduced sometime next year. So, my belief is that the pie is big enough for every type of instrument to be utilized. It really comes down to price transparency and best advice for an end client. So if advisor is still using an active strategy, it's probably the best thing for his client, but single factor beta ETFs, they are, the cost is pretty inexpensive, and I think that they'll be adopted further going forward.
And this move towards non-transparent ETFs, out of active mutual funds into non-transparent ETFs, that's such a big thing right now. We haven't seen it really happening in any extent. A lot of people seem to feel that this is going to be the savior of the active management industry, but I don't understand this. If you're mediocre at an active mutual fund, why are you going to be better at an actively managed ETF, even if the fee is slightly lower?
Look, the winners will win because they deliver the best thing for their client and actually make money in returns. But it really is about delivering the model. The ETF wrapper is going to become the investor choice utilization model.
Yeah. Let's move on here because I want to get to my favorite topic, which is Bitcoin ETFs. We still get emails, folks. I can't tell you. It's yet another deadline. Go ahead, laugh, Matt. That's why we have you here. It's another deadline for a long-delayed Bitcoin ETF. After turning down application after application, the SEC is expected to issue a ruling by next Monday on one of the last Bitcoin ETFs that's still outstanding. This one from Bitwise Investments. Fortunately, we have an update from Bitwise's Matt Hougan. Matt, it's hard to describe what a long and winding road this is. Are we any closer? You've spent a lot of time at the SEC explaining your model. Are they any more receptive to the idea than they were a year and a half ago when they basically shut the whole thing down?
Oh, absolutely, Bob. You got to think about everything that's changed in the Bitcoin market over the last 2 years. 2 years ago, there were no regulated insured custodians in the Bitcoin market. Today, there are almost 10. They're big names like Fidelity and Coinbase. They have hundreds of millions of dollars of insurance from firms like Lloyd's of London. 2 years ago, there were no regulated crypto exchanges. Now 6 of the 10 big crypto exchanges are regulated by the New York Department of State with market surveillance technologies in place. And most importantly, 2 years ago, it was a one-sided, inefficient market. Today, we have $200+ million in volume in regulated futures every day. Jane Street and Susquehanna and other big market makers are in the market. The market is trading at penny-wide spreads. It's among the most efficient institutional markets in the world. So not just the work that Bitwise did. Yes, we submitted a lot of research to the SEC and met with them multiple times. But just the evolution of the Bitcoin market over the last 2 years is from night to day. And that's why I think we're closer than we've ever been before to getting a Bitcoin ETF approved.
Now, about, was it January of last year, the ETF basically submitted what I call the 1,000 question memorandum, where they issued a long list of questions to everybody out there applying for a Bitcoin ETF. You've got to answer all the questions, and they went on and on. It was rather remarkable, but it fell into two buckets. One was, we have problems with these exchanges. Most of them are overseas and unregulated, and we have no control over them. One problem. Second problem is custody. We see break-ins. We see all sorts of problems with these, with the way the custody situation is set up. Can you address those two core problems with the SEC and what your Bitcoin ETF now, how it would address those two issues?
Yeah, that's great. So I'd say custody is really a solved problem in crypto right now. As I mentioned, there are now a large number of regulated, insured custodians with hundreds of millions of dollars of insurance in place. So I think that issue has just gone away over the last 2 years. I think the issue of market surveillance and market quality is the one that people are going to be focused on. We've approached it two ways. One, we did a lot of research on what the real nature of the Bitcoin market is. People's views of the Bitcoin market are often anchored a few years ago when it was a wild, wild west. So we submitted hundreds of pages of research showing that the market is truly efficient. But the key, Bob, is the growth of that regulated CME Bitcoin futures market. As I said, it's now trading $200+ million a day. It's about 20 to 30% the size of the total Bitcoin spot market. And that matters because one of the things the SEC said in that Winklevoss response that you referenced is that if there is a large, significant regulated derivatives market trading side by side with the Bitcoin spot market, that can solve the problem of market surveillance. So the question before the SEC is whether that market is big enough and significant enough to sort of solve their fears of the unregulated nature of some portion of the Bitcoin spot market.
Matt, this is Tom. This whole thing is not going away. It's not a fad. There's a big desire among financial advisors to solve this requests from their clients to participate in crypto as opposed to them going rogue and doing something themselves. You and I have done a lot of research together in the advisor community. What would this ETF bring as far as stability for their average client?
Yeah, that's a great question, Tom. Look, the opportunity that's taking place in Bitcoin, crypto, and blockchain today is one of the most exciting wealth generation opportunities in the world. And you know that because Bitcoin is the single best performing asset over the last 5 years, up about 2,000%. And a lot of people think that will continue. The problem is, while big institutions have safe, secure ways to buy Bitcoin today in private funds that are available only to the ultra high net worth people, regular investors don't have a safe way. Their best approach is to take out their cell phone, dial up an app, hope they don't forget their password, hope their phone doesn't get ported. What the Bitcoin ETF would allow everyday investors to do is have safe, simple, secure access to the wealth generation taking place in Bitcoin and crypto. It would let financial advisors give it to their clients easily instead of them going rogue, as how you said. It's just trying to solve that problem of simple, secure access to what is emerging as a very important technology and a very important asset class in the market.
Reggie, we've talked about this before many times, and I think the problem the SEC has is very simple. It's the grandma problem. Is it safe to sell it to grandma? It's one thing. The CFTC is futures. They view that as a different business. Those are professionals who want to buy this. But selling Bitcoin to grandma, I don't think the head of the SEC wants to get hauled in front of Congress 5 years from now with Bitcoin at $100 saying, are you the fellow who approved selling this to grandma? Do you think Bitcoin is getting close enough, the way Matt's describing it, to sell it to grandma?
Well, I think it comes down to the views of the regulators. I think their chief concern is about investor protections. With the right mix of transparency and fiduciary responsibility to the investor, an approval will come. I think there's still a road to travel, but I think we're getting closer.
Okay. Tom, last word?
Well, I would say we look at inverse and leverage all the time, and I know you're not a big fan, but we've come a long way, and I think from an educational standpoint, if they approve something like this, a 2% allocation in a long-term portfolio
that's the argument.
isn't going to hurt you.
Yeah. Tom, just give us an update here. When is the ruling has to come down, and what do they have to say? Could they postpone it again? What's the alternatives here for the SEC?
Matt?
Matt, I'm sorry.
Yeah, so sometime before Monday, the SEC has to give its decision, yes or no. They have no more ways to postpone it at this point. We will hear clearly between now and Monday what they think. And then, depending on what we hear, we'll go forward from there. But it should be a very exciting week.
Can they say no now, but if you tighten this up, is it just a straight up or down?
Oh, no, absolutely. They'll provide detailed guidance. At least we expect them to provide detailed guidance on which questions they think have been successfully answered, which questions, if any, remain. So we'll know how close we are to the goal line, if we're all the way in or still a few yards outside.
Okay, Matt, thanks very much. Always a pleasure to see you. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Matt Hougan from San Francisco, Reggie Browne, and Tom Lydon for joining us today. And thank you for watching. And you can, as always, find all of our latest videos right here on our website, etfedge.cnbc.com. We're going to see you next Monday, of course, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.